if you had if you had a large portfolio of stocks or assets and you went into this pandemic, after the Fed ended up expanding the money supply with the interest rates going to zero and the expansion of the M2 monetary base, the money base, you found that you were actually 25, 30% wealthy or doing nothing. You could have done nothing the entire year. As long as, right, the only mistake you could have made is do something, right? If you had $1 billion and you did nothing for the entire year, you had $1.3 billion at the end of the year. On the other hand, if you had a Main Street company and you're generating, let's say, $100 million a year in cash flow and you're valued at $1 billion because of the cash flow, you would have to be generating 130 million after a year to be valued the same, because the value, the assets that the money buy is being devalued by 30%. If the currency is devalued at some rate, and the money supply expanded to 24% last year, so you could use that as your metric, or you could use the S&P 500's return as another metric. But clearly, the currency devalued, which means that if you're a Main Street company, you had to work 20% harder to get nothing. And if you're a Wall Street company, you had to do nothing to get 20% better. And so what I saw was a shift in balance of power, and a shift in wealth. And it was pretty disturbing to me too. It's like, you don't want to be the dentist working for a fixed amount of money that's getting 20% less valuable every year. So the inflation is the cost of stuff. If the money supply is expanding, that means the currency is devaluing. In a closed system, if we want to make that simple, I live in a town and there's 1,000 houses, and I double the amount of currency in the town, and everybody wants a house. What's the price of houses do, right? If the only thing I can buy is a house, and if I double the amount of currency, then the price of the house must go up. Probably go up by 2, but maybe not exactly by 2, but it goes up. If I increase the amount of money, if I raise everybody's salary by a factor of 10, and I keep the number of houses constant, one might presume that the price of houses will go up. How will inflation actually take place? Well, there's a different coefficient for the price gradient, the change in price for everything you might want to buy, and it's different at every point in time. So, for example, if I put you in lockdown and I make it illegal to go to the movies, and I make it illegal to go to a restaurant, then the price of restaurants and movie theaters aren't going to go up. If I make it illegal or inappropriate to go on a cruise and fly in an airplane, then the price of cruise tickets and movie theater tickets and restaurants, they just don't go up, because you can't buy them if you want to. There's no velocity on that money. Okay, what can you buy? You can buy stocks. You can buy crypto, right? So what does go up? Well, if I give you $1,000 and you can go and you can buy stocks, then the price of stocks go up. Now, what happens next? Well, so everybody gets locked into their apartment and they decide they really want a house with grass. So what happened next? Well, 12 weeks after the lockdowns, the price of suburban housing went up and people started trying to buy houses. They said, this is unprecedented. We've never had so much demand for houses in the suburbs of New York. Well, that's not a surprise. You know what? If your choice is, if I close the parks in the cities and I close your office, then why wouldn't you move out into the country and live at a house with green grass, right? You're not the utility. You're not missing out on a restaurant. You're not missing out on a park. You're not missing out on your job. So rational human behavior causes people to take their money and go buy things they want. And where do they buy them? Well, Hampton's real estate went up in price 50%. Palm Beach, they go to the places where they want to go. Did the price of land in the middle of North Dakota go up by 50%? Not so much. It's not a scarce, desirable asset by people stampeding.
inflation is our problem, but we have the confounding variable of the average person is being told by sort of the mainstream media, by the government, hey, inflation's not a problem. They look at their basket of Netflix and bread and whatever, and it all seems fine. They're getting their stimulus check. There's no worry. But the reality of inflation is completely different. And we're now seeing a break in the narrative from the government saying, well, actually, inflation is, whatever, twice what we thought it was. And that may be just the tip of an iceberg that's coming. So inflation is a problem in two ways. One, if you pour money into the system, inflation is going to go up on a certain set of items. And then number two, if you're confused about what inflation is because it is not simple arithmetic, you're now paralyzed, especially when that's confounded by marketing, essentially.
Let's do the thought experiment. What if we didn't print any more money? What if the inflation rate, the monetary inflation rate, not the CPI, but what if the money expansion rate was zero? In that case, the currency is also an asset and it's a store of value and a medium of exchange at the same time. That's a complete Austrian economics, like deflationary economy, where we call it hard money or sound money. The closest thing to that would be the gold standard. If the government said you can exchange your money for gold at any time and we'll keep gold equal to the amount of money and we won't print any more money, well, that puts you on a hard money standard. In that case, you could just store your money in a bank and it would be more valuable in the future, not less valuable. When the government goes off the gold standard, and we went off the gold standard explicitly in 1971, now the currency is losing some percent of its purchasing power every year because it's being inflated away. And what's the number? Well, it was about 7% a year, and now it's like 20% a year, and 15 to 20% a year. And you got to figure out, is it 15, 20, or 25? But if it's 15 to 20, the currency is weakening 1 to 2% a month. When it gets to be 40 to 50, it's collapsing. That's Argentina, or worse. So you've either got a country where the currency is weakening or a country where the currency is collapsing. When that happens, now you have a decomposition. The money is broken into two components. You have a currency component, which you use as a legal medium of exchange, like the dollar or the euro or the yen or the renminbi. And then you have an asset component, which you use as a store of value over the long term. Money or U.S. dollars have ceased to be a store of value for at least the past decade, since the great financial crisis. So what people did was they stampeded into ETFs and index funds, right? And to a certain extent, bonds, right? How do you store your value over the long term? Well, if I take money and I buy a mixture of stocks and bonds, that will store my value, because if the economy is healthy, the stocks go up by 10% a year. The S&P does. And if the economy is not healthy, the Fed will lower the interest rates by 50 basis points and the bond will trade up. And so that works for how long? It works. Watch the interest rates for the last decade. It works until you crank the interest rates down to zero.
The Federal Reserve cut the Fed fund rate to essentially zero in March 2020 in response to the coronavirus crisis.